Today, I wanted to talk about personal insurance. And when I say personal insurance, I mean life, TBD, trauma, and income protection. I see a lot on Reddit and men's finance pages on Facebook, stuff like that, that insurance is a Ponzi scheme, which is why people need to continue to buy into it. That's not the case. Insurance is all about probability. And because of that, we have something called the law of large numbers. So let's take this 50-cent coin, which is representative of how much a pie used to cost at my tuck shop at my primary school when I was a kid, also how much public transport currently costs, and in this day and age, how much the little squeezy sauce packet that comes with your $8 pie costs. So the coin has got a 50-50 chance of heads or tails. I know someone's going to comment in here and go, well, actually, there's a chance that it could land on the side. It's not going to happen. Never fucking happened. Just leave it alone. So, realistically, we flip it twice. We should get one heads and one tails. But there is that chance that we could end up with two heads or two tails. When we flip it 4 times, there's still that chance that we could end up with 4 heads or 4 tails, or 3 heads or 3 tails. But what you'll see is the more flips you do, so let's go 10 flips, everything is going to, head towards one standard deviation of error. So instead of having 100% tails when we did 2 flips, even though the probability is 50. When we do 10 flips, we should come closer to that 50% mark. So, we might end up with a 40-60 split or something like that. And then as we go to 100, that probability, we start to get closer to that 50% benchmark. And the same thing happens with personal insurance. So we know the mortality rate. We know the chances of time off work, chances of cancer, those sorts of things. This is how insurance is calculated. But the problem is that's based on the whole audience. It not just what the insurance company has captured. And when I say captured, I mean paying a premium. Captured, probably the wrong term. So, again, insurance companies need these large amounts of people on their books so that they can accurately predict the probability of claim. And the larger the book, the easier it is to calculate the probability of claim, which means that they could start bringing their fees down a little bit. But what we're already starting to see in the market as well is insurance companies modifying their entry points. And what I mean by that is either making them more expensive or less expensive depending on age, gender, and occupation. That way they can keep kind of an average subset or a reflective book of the averages. So personal insurance isn't a Ponzi scheme. It all comes down to probability and the law of large numbers. Always ask yourself as well when taking that insurance is, what would my life look like if something occurred and I didn't have insurance? So everyone always underestimates the importance of your own ability to produce an income, because when you're first starting out, that is usually your greatest asset. Personally, I have life, TBD, trauma, and income protection. My wife's got a severity-based cover policy, and Albie, as soon as he turned 2, he has a policy as well. The reason being is if something happened to him, either Kelly or I would have had to have taken time off work, so we would have needed that lump sum of money to cover that occupation. But there we have it. Insurance is just all about flipping a coin. That it's not. And that's all. Thank you.